Hey, welcome back, everybody, to the Financial Advisors Workshop. And this is the show, folks, where we talk to some of the top financial advisors in America. There are literally, 330 million people in America, and there's about 1 million people that support them financially. And we're going to talk to the best of the breed. And today, a real special treat, a friend of mine met a number of years ago, Ryan Fleischer. And Ryan is the CIO, founder, and CEO of the Revolution Group in West Omaha, Nebraska. Ryan, welcome, Financial Advisor Workshop.
Thanks, Ryan, and thanks for having me.
Absolutely. Well, good. Well, this is a real treat because we've had some real conversations about how you run the firm at different conferences. And, tell us, Ryan, if you would, you've been a financial advisor for a while, and then you founded Revolution Group. Tell us about that. Tell us how you founded the firm.
Well, it's interesting enough how I founded it. I started the business, 4 years ago, and really started at a firm, Waddell and Reed, which is a regional, national regional firm, and quickly moved up the ranks there, and was one of the top, was actually the top first-year advisor in the country there. But a lot, of course, has changed in those last 25 years. But really, back then there was no such thing as salaries. There was you always draws. It was a draw against like your commission. There was, fee-based really wasn't introduced at that point. It was that maybe just getting off the ground at that point, or fee only or fee based. It really wasn't even fee only. It was really fee based, if anything. And was Waddell and Reed was, of course, a really a mutual fund company. That's really what they were, an asset manager with an advisory force, and just was kind of blinded, drinking the Kool-Aid and learning the business. And they don't teach you this in college, of course. At least back then, there was no such thing as courses for financial advisors, or courses even for, I would say, overall money management. Maybe in the business schools and such, there was, but not back then. But slowly realized, like, hey, there's a lot of things happening outside of Waddell and Reed that I think are really, really cool. So I moved into a bank. I had a friend of mine that was kind of the grandson of a bank, the largest private bank in the world, which was headquartered here in Omaha. And they had a huge, basically retail division. They had a merchant processing division. They had trust, but also learned a lot there. What I thought was going to be conflict free wasn't necessarily, I would say, conflict free as a whole. You realize a lot. But I kind of wanted to get away from that. But everywhere I ended up, I was like, well, I have this dream of kind of owning, my own business, so to speak. So I ended up kind of hanging my shingle, was there for, at Waddell and Reed for 3 years, was at the bank for about 3.5 years. And then I joined as an independent LPL. Now, again, you don't realize what they talk about when they mean independent. Independent is independent. That means they hold your licenses. You're not an RA, of course. So I was at LPL for for 12, 13, 14 years. A lot of change happened at that point in time, of course, at the firm. But I always was looking for something more, and a lot of the opportunities that I couldn't do. I actually worked for a really large family office, over a $12 billion family. And what they were doing, I couldn't oftentimes do. I would ask, LPL if I could participate in it. And oftentimes the answer was, no, we're not going to let you. And if you want to participate, you could try to get it on they call it on the platform, of course. So, little that to get on, kind of their platform, if you will. There is generally a pay for shelf and so on and so forth. So I just realized there was this whole other world out there when it came to investing. And private investments. What was available on platform to what's off platform was totally different, from a strategy, from a success, the successes I was seeing oftentimes in, for myself and my family and my clients, that I was with at LPL. The successes were very different compared to the successors and returns that I was seeing, elsewhere. So that kind of made me want to go on and start my own, firm, in an RIA and become directly registered as an RIA. So that's kind of how it began. But one of the aha moments was when I was actually getting measured with a suit, and my tailor had a brochure of another financial company sitting there on his counter. And he was asking me about, typical talk. Hey, what do you think the economy is going? Where's the market going? And, of course, I gave him my opinion at that point in time. That was back in 2009, of course.
Right.
So,
Right.
but the one of the things he says, he goes, look, I just don't understand. He goes, I interviewed several advisors. I have 3 myself. You all promise the same thing, like you all are going to offer the best funds and this and that, and it's all, you're all out, performing about the same. It's kind of over promise and under deliver, and it kind of is that way, right? There's a lot of commoditized products, a commoditized feel out there. And I would say, just like a lot of people that make decisions, very emotionally driven, which we are as human beings, we tend to look at performance. We tend to oftentimes look at the rearview mirror when it comes to investing rather than being forward looking, and where the puck is heading, if you will. So a lot of what we've done and what has come to be done as a firm is really data driven. And
Mhm.
so we look at a lot of data, not only on the traditional markets, where, again, we could have a very deep conversation on, our philosophies, which is,
Mhm.
on the traditional side is very probably different from a lot of people.
Mhm.
But they're, from what we learned from the top quartile to bottom quartile on, kind of traditional asset classes, like whether you took all the large cap growth managers, SMA managers, mutual funds, you put them all in a bucket. Usually the difference in spread and return from top to bottom decile is about 30% or 3%. Sorry. You
Okay.
take the top quartile to bottom quartile, in private equity or in the private investments, the difference is 30% for your annualized return. So
Yeah.
sourcing in the private markets is much more important in how people are finding those deals and sourcing those, and constructing, not only just finding deals, but how you're placing those deals. So we really wanted to run our company like a family office. That's really how we wanted to do it. Just like if when somebody, like the family had their policy, they had their generational legacy plans all set up. They had the risk mitigation all set up. They had the purpose behind the money. They knew all those questions. They knew how they did define risk. So we run our methodology very much like that. And I just simply couldn't do that anywhere else where I was at, and I had to do that in order to start my own firm.
Yeah. Really, really interesting. And as you describe, your evolution and how you come up to founding your own firm, it sounds like there's been a lot of changes along the way that you've seen, and then you've kind of built the best of those changes into the firm.
Yeah, absolutely. I mean, the industry as a whole has changed as light years, as I described on,
Yeah.
originally how, it was a lot of commission based, business, as you probably you yourself know
Yeah.
how it's evolved. Um, just the way things are, I would say, that are done, but also, just the way business transacts. I mean, you look at the way you trade a stock now. It's instantaneously. I mean, we've gone from T+3 to T+2 to T+1 in some cases. It's really, everything is really, really changing. And things has become much, quicker and smarter and better from that capacity. But also what's kind of what's available, like I said, this is where I would say it's not kind of a one size fits all. It's a lot of times, I'm relying on connections and that kind of the asymmetric private information that's perfectly legal to use on the private markets to go and source and define our connections in the private markets with different operators and top decile operators where it may not be accessible. They're not going to be accessible at, your big banks or trust companies or insurance companies, kind of your franchise firms, if you will. I mean, they're going to generally try to fit you in the box. And oftentimes those, unfortunately, those products as to why maybe people end up with them might be for other reasons besides just, hey, you feel they're the best. It could be because for several reasons. So I just wanted to get completely away from that. So we actually developed what we call and trademark the real fiduciary. We trademark that. That's a 10-point process. So we have very strict processes in place that put, that are centered around our core values as a firm, but also, it's centered around putting the client first and everything that we do, on that 10-point process is 100% conflict free. It's easy to say you're conflict free, but very, very, very few firms are conflict free, I would say, and unbiased.
Yes. Yeah, I was going to ask you about real fiduciary. So that is something that you, as you say, you trademarked yourself. And so others now can't use that. And that's the 10-point process keeps everybody on track, doesn't it?
Yeah, I wouldn't say necessarily, I would say keeps them on track, but it's a process we certainly do use, and we do go over as a differentiator and value add for our clients to say, here's how we do business, or here's how you might be doing business right now, and you're unhappy, but here's maybe some of the reasons why that's the case for whatever reason. So we really, use that as really a process of what the client, care level and conflict free and everything that we do and don't do is developed around that 10-point real fiduciary process. So when we, again, starting the firm, you really have to look at not only what you want to be as a firm, but what you don't want to be as a firm. And like I said, there's a lot of commoditized firms out there. They're all generally, and I came from them, and maybe you did too, but a lot of them are operating off of a menu, off of a platform, if you will. And again, oftentimes why maybe some of those funds or products or whatever the case may be are there oftentimes maybe not for the right reasons. So you really have to, again, that's where we don't have anybody that are really controlling on what we can and can't do. We feel like what we're doing is 100% in our clients' best interests at all point in times, because we don't operate off any commissions. There's no revenue sharing agreements or anything of that nature for us. So the reason why we do what we do, and we're also negotiating oftentimes at the product level, at the firm level, with various operators to get really good economics. So, and I participate as the economics pari passu with our client as well. Another important aspect is we have one uniform cost schedule for everybody. Nobody, my own family, our employees, they're all on the same cost schedule as our clients, because we want them to experience the same exact treatment equally. So we feel that that is extremely fair across the board. So again, the underlying economics on deal terms, we negotiate that for our clients, and oftentimes it's pretty substantial discounts out of the box, especially on the private side of things. And a lot of what we do is on the private side of things.
Excellent. So a couple of things you brought up, I think were really key, is that as you went through the industry, you realized that many of the firms are set up really more to offer products that the firm is comfortable with, but they often take payments and other things. So it isn't really like a collection of the best, is it, Ryan? It's more like whatever they get paid to do. And it's not really the best for the client, is it?
No, yeah, it is. I mean, I won't name any names, but it's becoming more, I would say, shed the light, at least on industry news, stuff that probably you and I might read. You would really have to ask yourself as an advisor, that, hey, is what I'm being able to offer my clients, is there a reason why this is maybe on what they call on platform? Is it because really what's in the best interest of the client, or is it in the best interest of maybe the corporate profits or possibly private equity profits? You see a lot of course, private equity stepping in and buying a lot of firms too, and they're participating in this too as well. But one of the bigger banks, which I won't name names, just one mutual fund firm, took $60 million in revenue sharing agreement just in 1 year. 1 year. So you have to, again, ask yourself, hey, was this really what was in the right interest of the client? Or was that we were mainly forced to push that product onto our clients because the more that we offered or sold or whatever the case may be, the firm was going to get paid more. Of course, that's a huge conflict of interest. So we wanted to eliminate all that, and that's a big one. That's a really big one. But we also wanted to be free from any banks, from insurance companies, custodial relationships. I mean, we could custody with whoever we wanted the custody with, who we thought was our best in the best interest of our clients. So again, that's all part of that, but that's what's happening, out there. And it is I hate to say it, but it is a secret. And I found out about it by really happenstance, probably close to maybe a dozen years ago that was happening. But I really think a lot of people in our industry have no idea, advisors included, that that's really, happening. I know certainly the clients don't know this, but I think a lot of advisors don't realize that they're oftentimes their firms, and the reason why there may be a zero transaction fee or a zero mutual fund fee or whatever the case may be, or the reason why they're even allowed to offer maybe on the private side is big checks are exchanged kind of under the table that you never ever see. So.
And so Ryan, all those things in the broker world are legal, but there's certainly conflicts. So that's not really allowed in the fiduciary world, is it?
Well, you can still take revenue sharing agreements, believe it or not, as a fiduciary. I mean, if you use and that's why we kind of again developed the term real fiduciary, because the term fiduciary is such a very loose-lipped term. It probably doesn't even carry as much weight as it once did 3 years ago. Everybody is using that term fiduciary. I mean, we had people here in town that are selling commissionable based products and annuities that are still calling themselves a fiduciary. So you can it's perfectly legal to accept pay for shelf under the table, believe it or not, and still be a cost base or a kind of a fee, what they call a fee only advisor. Now I would argue, you really can't be a fiduciary, but these are just where we're at in this point in time.
Yeah.
with the industry. So,
But the
but
beauty,
I would say you really shouldn't be called a fiduciary. I'd argue that. That's why we actually had to coin the term real fiduciary.
right. So that's how you operate. That's how Four Star operates as well. We don't take any of those payments. And it's not right. And it doesn't, it keeps us free of those conflicts. And that's a good thing for the investor.
Yeah, absolutely. It's a very good thing. I mean, imagine, imagine you being an investor, put yourself in an investor's shoes as the reason why you end up with the product is because the firm was getting, paid a certain amount of money under the table. And these are
Right.
RIA firms, right? These are RIA firms, corporate RIA firms that are taking these payments.
Right, right. Well, and there's a big difference between the large corporate RIAs and then the kind of independent RIAs that are not part of a big corporation that's owned by a bank or whatever. And that's your firm, that's our firm as well. And most of the 32,600 firms that are out there, either SEC registered or state registered, most of them are not the big corporate RIAs.
Yeah, absolutely. And there's, I would say, some of the firms here, in town that are REAs, kind of what you're talking about. They are taking pay for shelf and pay for revenue as well. So you just really, if you really want to know, you read the ADVs of the companies to see if they have revenue sharing agreements in place. It ends up
Right.
being, a lengthy process. It's not something we really care about, from firm to firm. We just focus on ourselves on, hey, here's how we want to do business. We think it's fair this way, and our number one core value is client first, and that's what we're focused on. And there's no way, there's no way you could be client first if you had that type of conflict in place, no matter whether you accepted that or not. I just don't think you could be client first focused.
Yeah. Well, and for sure, the broker dealers that take all those big fees and big payments and platform fees, I call them extortion fees. Clearly are not offering. They're not this passionate about what is offered. You're offered what they get the most payment for, and that's really the best thing for the client.
No, 100%. I mean, and I was like I said, I was with LPL for a number of years, and again, I'm probably like a lot when you talk about, pay and you talk about that stuff, you don't realize, I mean, I didn't realize that was actually, I would say taking place. I actually happened to sit next to a controller on an airplane, heading to a national conference, and he had a pre-meeting before. And I about my jaw hit the ground, the size of check, that his firm was writing, to firms. I mean, it was interesting, very, very interesting to hear it. But that's kind of how I found out about it originally. But again, we really, I think, we're doing it the right way, and that's there's firms out there, I think, that maybe don't do it necessarily the right way, but there's certainly firms out there that that do it, the right way, too. But it's
Yeah.
just, again, you realize, you start to realize these types of things, it being in an industry, and a lot of that is happenstance. But Brian, I mean, I've had conversations with people at other firms, and that are taking these huge checks, and when I say, hey, I just heard this or whatever, that your firm took this amount of revenue sharing agreement, and they're just like, no, we don't do that. And I have to show them the article, and they're just like, oh wow, I had no idea. I had no idea that
Right.
they don't tell us that, basically.
Yeah,
So
that's right. That's right. They don't disclose it, so it's not a great practice. So it's better to be a real fiduciary, as you say, and have that clean perspective, and doing really work just for the client, and not to take money from a sponsor.
yeah, right. I mean, like, again, we are cost only, or a lot of people would say fee only, if you will. There is a difference between fee based and fee only too. Based oftentimes means you might have a fee based on some stuff, but you might be charging commissions on others, or you might be accepting revenue sharing agreements if you're fee based, right? But being what we're only costs only, we only again accept that the charges are, our discounts are passed down on the providers we negotiate on the corporate level. That all passes down to our clients. We don't get anything, and we charge the client a cost, right? A cost to do business. Oftentimes, no out of pocket costs. It's coming from the profits of their portfolios.
Yeah, interesting. Hey, switching gears, we talked about being data driven. Let's talk a little bit about that more. I mean, the data that you compile, what kind of data is it? And then how do you use it to drive success for clients?
Yeah, so we strongly believe, in organic growth. We haven't made any, in our 5 years as a registered investment advisor, we have not made any type of acquisitions at all. We've hired other advisors. My wife actually works for me. She became an advisor
Great.
per se, but she really doesn't give a lot of advice. It's more she became an advisor, become familiar with a little bit of the lingo of the testing to become an advisor. But we really believed in hand-to-hand combat, getting in front of a clientele, getting in front of people we believe that we can help. But we do learning events. Usually, we'll do a couple learning events every month. We host private summits as well. So we've done a private credit summit where we brought in some of the top decile private credit operators from around the world into Omaha, and we had our clients come to those, and our prospects come to those. Not only that, but some endowments, foundation, family offices, so on and so forth. This next week, the College World Series is actually in town right now. We're actually hosting a private equity summit. So we'll have 4 private equity managers that are top decile operators from around the country that'll come into Omaha. They each will speak for about 45 minutes about what their value is in private equity. And then we'll talk about Revolution Group and the data. But again, we talk about a lot on fact versus fiction. How do you appropriately use private equity, right? Again, top decile private equity from top to bottom is a 30% difference in annualized rates of return. Annualized rates of return. That's significant, right? So we look at data that way. On the traditional side, the variables that make up your asset allocation on the traditional side oftentimes isn't what you think it is, like security selection. Even times a lot of people will say, oh, I'm really focused on costs or fees on the internalized costs, right? Well, Brinson and Ibbotson did, a couple studies on the variables that make up the traditional asset classes. They found between 93 to 100% of your success is going to be based on your allocation, right? Also, too, I mean, our data is also driven on what we do, which is more factor methodology, right? A lot of people don't quite understand what factor methodology is, but that's what we practice on our traditional asset class side. And we don't get into hiring what they call like an active manager, right? And I have a deep research just from my time in business school and my fellowship time in studying this and what's fact and fiction. And I think what's financial gospel out there is kind of pushed down our throat. I mean, we watch a lot of maybe CNBC or whatever the case may be, or Fox Business, and it's exciting, right? When a manager goes on there and talks about, hey, here's my picks and here's this and here's that. But for us, it's really about the data and the probability. And really what we found out is, crystal balling the market over the last 100 years. If you look at 100 years of data and said, all right, let's just say for the time being, we're in an interest rate environment that could go maybe higher, go a little bit lower, probably We talk a lot about interest rates cutting next, right?
Yeah.
Well, again, just knowing that, where do you want to tilt towards? Or, hey, I think there could be a recession, right? Where do you want to generally, tilt towards, right? We all know that the interest rate projectivity has been dead wrong, right? Been completely dead wrong. And so we don't get into trying to be predictive. We just don't, because we know the data, and studying with my own eyes, you have a 13% chance of being 95% right when it comes to crystal balling the stock market. So imagine that. I mean, about a 1 in 10 chance of crystal balling, even that's using the data. That's actually using the data, Brian. That's not saying, hey, I'm using a gut feeling here, That's actually taking the data and then positioning that data. So same thing. And if you look also at active management, on the traditional side of things, you look at SMA managers, you look at mutual fund managers, right? Statistically, over a 3-year period of time, 90% of active managers are underperforming the respective benchmarks. 90%. That's hard to believe. And then you add, I went back to S&P Global because they have all the data, right? And I said, hey, have you ever put together anything that shows you the after tax? So if I was doing this outside of a qualified account, an IRA and these managers, mutual fund managers, SMA managers, what would that look like? And they're like, that's a great question. We've never put that together, but they were kind enough to do that. And what they found out that after basically 3 years, it was after tax, about 97% of managers underperformed after tax their respective benchmark. That's astounding. I mean, it's amazing to me. And they were on average underperforming their respective benchmark by 3%. After 10 years, it was 3.5%. So it only gets worse, right? So, I mean, so we look at a lot of stuff. We look at the fact that there's an 80% turnover amongst active managers, right? And if you're turning over 80% year over year, that means if you have any gains, what does that mean? You're going to have ordinary income tax passed on, right? Or you're going to have some losses to offset that. So again, how we take that data all goes into where we do to construct our portfolio and what we believe in, which is, again, it all on the traditional asset side comes back to factor methodology, which in time, the research and the more recent research that's not data mined, I would be also very caution. I don't know about you, Brian, but I've never seen a really bad test results when somebody shows you their performance and they say, hey, we know this is a newer fund, but we've been doing a strategy for 10 years, and they show you the data and the back tested results look wonderful. And you're wondering, like, well, why isn't this looking the same after I bought it? Right. They all of a sudden lost the magic touch. Right. Exactly. But, again, we just look at that, the probability of that. And, this may make a lot of people maybe upset around Omaha, here, but we have a guy, Warren Buffett, right? But most people don't understand that Warren Buffett over the last 20 years has underperformed the total return of the S&P 500 by close to 40%, close to 40%. So people don't also realize if they just look at the index, you got to look at the total return, because of the S&P 500, 30% on average of the S&P 500's return comes from dividends, right? Yeah, right. So you just can't look at the index, just the index itself. So just the world has changed. Like I became, Warren Buffett was not taking anything away from Warren at all, but the world has changed. The world and what he, how he became this investor, and how he operated, and being able to select, oftentimes private companies to form his conglomerate, to become this big whale that he's become. Now it's just the world has changed. You have access to the same information that oftentimes Warren was using to his advantage, and knew how to use that when he would go in. And now private equity is more readily available, right. And you're starting to see that. But it's just, one would say, will Warren ever be able to outperform the respective benchmarks over a longer period of time again? And my guess is the data tells me probably not. But we're still going to become very infatuated by every single move that he's going to make.
Yes. And he had some great years in the early days, and that's what built his reputation. But the recent performance hasn't been as good. And I think you're correct to point that out.
Yeah. Yeah. I mean, and that's, I thought, again, a lot of people don't realize that, and they just take it as like, again, gospel, and we're hanging on that. They find it very shocking to realize that.
Yeah. Well, it's really interesting. You've got a great approach, and the real fiduciary concept makes a lot of sense. And the fact that you're so data driven, people will know that, this is real stuff, and it's not just based on conjecture and our belief in this or that, kind of wag's tail. It's really real stuff, and that people need real returns as well as a real fiduciary. So I think people can feel comfortable, Ryan, working with your firm and doing all those things, because you're going to be honest about it and tell the truth about it.
Yeah, I mean, they shouldn't expect anything different, right? I mean,
Yeah.
it's what I would always say is,
Oh, you would think, right? Yeah, you would
yeah.
think. Sure.
But
Well, good.
again, what I would just point out is a lot of people don't probably realize, again, not to put the industry down, but I think the industry overall, we talk about transformation, and that's what Revolution Group stands for, a marked change, right? But again, we think that the financial industry really, I'm 100% in favor of free market capitalism. I mean, I'm 100% in favor of not being able to limit or anything of that nature your choices. But there certainly is things out there that I believe could be, transformational. But what has given us, and probably your firm too as well, is the competition, right? If you're able to find value in what you do, right, and be able to explain that value in what you do to a client, in amongst, I would call it a commoditized, really has become really a commoditized industry to a very big degree,
Yes.
across a firm level, then that's going to only bode well for firms like REAs and stuff that want to do it differently, like ourselves. So hey, I embrace it in that way, but I also wish, with that being said, that certain people, of course, wouldn't be taken advantage of maybe in the manner of which they are, because again, as you're probably aware, Brian, again, looking at the data, when you talk to even centers of influence, whether it be accountants or estate planning attorneys, if you just say the term wealth firm or financial advisor, you're kind of just being lumped into this box, right?
Right.
They don't really know any different, and they're just kind of, hey, it's black and white, right? They don't realize really what, maybe there's a significant difference in this value and what you can be able to create. So we want to be, we want to do it the right way, and we will always do it the right way, as long as we're around to good Lord willing. So
Absolutely. Well, great. Well, Ryan, this has been a great discussion. I think everybody will be very impressed with all the things you said, and we're looking for more and more people to see this interview, because if you're certainly in the markets you work in, Ryan, and that could be Omaha, but it could be all around the country, couldn't it? For investors. Yeah.
Yeah,
So,
we have clients kind of all over, spread out, and in some cases even overseas.
well, that's great. And so for folks who are really looking for a very high quality approach, data driven, and really a fiduciary, and really in the spirit, in the letter and the spirit of the rules, you are clearly, and your firm is clearly there in Revolution Group. Ryan, we're coming to the end of our discussion today, and I just wanted to see if you have one final message you'd like to send to, assuming some investors will see this, but most financial advisors are going to see this primarily. And we'd love for you to give them your general message as we depart today. What would you like to tell the brethren in our industry, the great ladies and gentlemen that work for clients just like you and I do?
Yeah, I'd probably share the same message we're sharing with our clients and even our, prospects. I would just say we're probably at a period of time where it's probably one of the most important times in your lifetime to carefully select who you partner with, not only as a firm and individual. And that would be my message, because it is as this conversation kind of has gone, there's a lot of things out there that probably folks don't realize, and whether clients certainly, but advisors certainly at firms. So I would say who you select to partner with as your firm as an advisor is very, very important. Now, we're not probably like you, Brian, that are trying to source advisors maybe all over the country. We're very much Omaha kind of driven and centric. We're not trying to hire a bunch of other, financial firm advisors at other around other areas. That's just not our methodology and modeling. But I would just say same message across. I think we're at a crossroads, and maybe to use a Warren Buffett, maybe a quote. We're going to probably find out here in the next couple of years who's swimming naked.
Yeah, exactly. Well, great. Well, thanks, Ryan. This has been a great session, and we've all learned a lot, and we appreciate you joining us today.
Thanks so much for having me on, Brian. Appreciate it.
Well, thanks, Ryan, and thanks to all of you for watching today as we have a conversation with Ryan. And we're going to be back with another great advisor that we can all learn from and make our industry better and better. And that's what this is all about. So let's say goodbye for today. Again, thanks to you, Ryan, for being with us.
Thank you.
All right, everybody, over and out. This is 4-Star Wealth. We'll be back again with another interview very shortly. And thanks for being with us today, everybody. Bye-bye now.